If you are a high-earning physician, it probably comes as no surprise that you pay a lot of money in taxes. But what if one of the things or many of the things that you were already doing were actually increasing your tax bill more so than it necessarily needed to be in the present day and potentially into future years as well? That is the crux or purpose of today's video, is highlighting 3 common tax traps we find physicians falling into and effectively providing ways to avoid those tax traps to begin with. The first is a fairly common one, actually, and that's for physicians or really high income earners contributing to Roth-type workplace retirement plans. These would be things like Roth 401ks, 401as, 403bs, 457bs, profit-sharing plans, and or 401as, or any combination of those types of plans, contributing to the Roth portion of those as opposed to the pre-tax portion. You're probably asking yourself, wait a minute, Roths are supposed to be the awesome account type. You don't pay taxes on withdrawals. And that is true. However, when we look at tax planning, we're looking at not only just today, potentially how much we can save in taxes, but also over the long term. For physicians who are really high income earners, and again, might have even higher incomes from a household perspective when combined with their spouse, you are likely paying the most money in taxes at the highest percentage today while you are working, as you likely ever will in your entire life. Think about it, as you're working, and this chart is a good kind of illustration of that, this fictitious example of an individual physician and their spouse. They have a really high income household, and during their working years, they're paying really high rates in taxes as a result of that. But you'll note that as soon as both are retired, that income drops way off and the tax bill or burden drops in tandem with it. So the idea of contributing to a pre-tax account or pre-tax workplace retirement plan as opposed to the Roth is really 2 things. Number 1, you're reducing your taxable income in the present day by any amount that you're contributing to those pre-tax accounts. It effectively functions like a tax deduction in the present year. You're reducing that income and reducing the taxes you pay. Secondly, is that we believe that even if tax rates are higher in the future, it's actually a fairly commonly held belief that rates today will be lower overall than they will be in the future. A variety of political implications and the way our governments are run kind of weighs on that. We won't get into that on this video. But even if you hold that to be true, the idea or belief that you will be in the 35 or 37% bracket in retirement seems fairly uncommon for most individuals, not completely out of the realm of possibility, but in general, we find or kind of believe that for those who are in those higher brackets today, that it's more advantageous for them to contribute to a pre-tax account, get that current day tax benefit, allow the funds to grow tax deferred, and then pull it out of their retirement accounts while in retirement, likely in a lower tax bracket than they are in the currently present high one they are today. So tax trap number 2 actually still typically falls within kind of the workplace options, if you will. And that's actually just simply for high income physicians to not be enrolled in a high deductible healthcare plan and not contributing to a health savings account or HSA. Variety of reasons for this, but the very simple concept is that, especially if you're just a pure W-2 doctor working for a hospital, for example, there aren't a ton of tax deductions that are available to you. It's very possible maybe you're itemizing on your returns. We can get into that here in a second. But if you're just taking the standard deduction, there's not a lot of tax deductions outside of that are available to you, unless you had a side hustle business or some sort of other deduction avenue to reduce your taxable income. HSAs, you have to be enrolled in a high deductible healthcare plan to have access to contribute to an HSA. But HSAs offer a great tax advantage for 3 primary reasons, and this is sometimes called the triple tax benefit of an HSA. Number 1 is that any funds contributed to an HSA are tax deductible in the present year. So that can be thousands of dollars that are potentially deductible for physicians. And like we talked about in tax trap number 1, when you're already in a really high tax bracket, any amount that we can reduce that taxable income by potentially saves you a decent amount of money. The second portion of an HSA, or the triple tax benefit that we talked about, the second aspect or element of that is that the funds are able to grow tax-free over time, just kind of like an IRA or a 401k. We're not taxed on earnings, dividends, interest, any capital gains within the account year over year over year. And that allows the account to basically grow potentially higher or faster than it could be maybe a taxable brokerage account or something like that. We're paying taxes on those earnings or income each year. That's kind of tax benefit number 2. And tax benefit number 3 of an HSA that's actually very unique, there's really no other account like this, is that HSA funds can be withdrawn at any point to reimburse yourself for medical expenses in the current year or to reimburse yourself for medical expenses from prior years. That's actually very unique from any kind of account. For an IRA or some sort of retirement account, you're going to be penalized typically for withdrawing funds prior to age 59 and a half. HSAs don't have that. So effectively, for what's a very common strategy that one might implement is to fund your HSA or max it out every year, invest the proceeds, probably fairly aggressively, depending on kind of what your age bracket or range or risk tolerance might look like, and then use that account effectively as a dedicated healthcare retirement account. So once you're retired, maybe even early retirement, knowing that, a lot of your healthcare costs might be covered by a health savings account for you and your spouse or dependents, that basically you can use that account to reimburse yourself for any medical expenses that might come up in retirement or even to cover Medicare premiums in retirement. The added benefit of an HSA, and we have a different video more on HSAs, kind of the benefits of them, is that you can treat the account like an IRA in retirement once you reach a certain age to basically pull the money out, pay taxes on it if it's not necessarily for healthcare expenses. But having that healthcare expense option is huge. And if your income is very high in the present day, the tax savings alone is a pretty compelling option or argument to use it over other healthcare options. But also that tax-deferred savings and potentially tax-free withdrawals is also really beneficial. So for high-income physicians, that one can be a very good option to potentially pursue. So I think third option, or kind of third tax trap, if you will, is more so just from a conceptual one that I think sometimes physicians will fall into. And it's fairly common for even just any high-income earner to think that certain deductions might apply to them when they really do not. So, for example, if you look on lots of websites or Google IRA contributions, should I be contributing to an IRA? You might see that, IRA contributions are tax deductible. Well, if your income is several $100,000s for your household, it's probably not tax deductible. So that likely doesn't apply to you. Another example might be student loan interest. If I have tens of thousands of dollars in student loans, maybe they're at decently high interest rates and I'm paying a decent amount of interest each year on those loans. Wouldn't it be great if I could deduct that interest? And for certain individuals, yes, student loan interest is deductible. Once you reach certain income thresholds, it is no longer deductible. So again, the mental math and kind of the overall analysis of should I keep my student loans? If you can't deduct the interest, suddenly the argument to keep them in any capacity starts to diminish, especially if the rates are high. And another one, just in general, is thinking that things like mortgage interest, charitable deductions, state and local taxes, these kinds of things we think about are as deductible. Are they deductible? And the answer is they might be if you're itemizing on your tax returns. But we know that even for high income earners today, it's very possible that you're not. Taking the standard deduction, you really aren't reaping any benefits from those otherwise deductions that you really can't take advantage of. And so overall, the tax trap is just this idea that I have all these tax deductions or options available to me, when in fact, you unfortunately really may not. That's not to say there aren't strategies to potentially make them available to you. For charitable gifting purposes, for example, you can utilize what's called a donor-advised fund to make lump sum contributions to step up your overall deductions to therefore make an itemized deduction. This might be good for you in certain high-income years to consider doing if you're charitably inclined. But otherwise, thinking that some of those might be deductible is just kind of a miss for some individuals. So all of these, I think, are important to keep in mind, and certainly we call them tax traps. Contributing to a Roth 401k is not a bad thing by any means, but is it the most efficient way for you as a high-income physician to build wealth and to really help achieve your goals by making your finances work for you? Probably not. So something to all keep in mind. My name is Scott Sturgeon. I'm the Senior Wealth Advisor at Oriad Wealth Partners. We help a lot of physicians work through things like this and really kind of work to align their finances overall, whether it's workplace plans or other investments or tax planning strategies, things like that, really to align their finances with what's the most important in their life. And maybe that's retirement, maybe it's financial independence, maybe it's education planning for the kids, whatever that might be, that's what we do. So thanks so much for tuning in. Links below to our newsletter. And if any of this is of interest to you, I would encourage you to reach out and schedule time. Be happy to talk through your individual finances and whether working with Oriad Wealth Partners might add value to them.